Okay, thank you for letting me know. And one more thing I have to fix here. Okay, good. And I can see what I need to see. No, I don't want that. Sorry, guys, just one more thing. No. Okay, I'm just going to accept that. I don't like the way that looks, but that's okay. All right. So let's go ahead and let's jump into chapter 4 now. Okay, and you can see, are you seeing the image full on your screen? Because that's the part that I'm not seeing here.
Yes.
Okay, I see what I'm doing wrong. Okay, I'm fixing it on my, I've joined as a participant as well. It wasn't looking right to me, but that's okay. I got it now. Okay, good. So let's go ahead and take a look, and we're going to talk a little about forecasting and projection techniques. That's a 5-point area on the exam, not very heavy. Okay. Ratio analysis. We've had tons of ratios now, guys. I'm not going to sit here and try to call out points for ratios because we have them all over. You just need to know the ratios. You need to know how to apply them. So when we get to that, I am going to ask you to once again look at the recording that Becker has there. I don't think you get a whole heck of a lot out of it when I sit here and I call out this ratio versus that ratio, divide this by that. I think you're much better off spending that time looking at the recorded lecture on those ratios that are there. But there's a ton of them in there. Make sure you got flashcards around those. Make sure you understand how to use those ratio. If you get a question, when you get multiple choice questions that ask you to apply those, okay? We'll talk about marginal analysis, and that's going to be about 5 points on the exam. Next time we will get into budgeting. That's about 5 points. Okay, now hear me on this, guys. Do not mess around with, not paying attention to discussion of variance analysis. This is a 10 to 15 point area on the exam. Okay, this has a long tradition on the exam. It is still something that they like to test heavily on. You will absolutely have variance analysis questions on your exam. You'll have multiple choice questions. You'll have a task-based simulation on this. They are going to test you on this on the BEC exam. Now, and we're going to do this next time, I have a way of showing you how to get through these variance analysis questions that really takes it to the point where these should be a relatively easy 10 to 15 points for you. Okay, so make sure that you're looking at that lecture when we have it next time. Together we're going to go through that, and that you're applying that when you go through your homework questions. Okay. All right. Any questions on these potential point values? And I apologize for the blue on blue. 5, 5, 5, 10 to 15 for variance analysis. Okay. All right, good. Let's go ahead and let's take a look. Now we start to talk about projection techniques. Now in here, they talk about projections, and really what we want to do here is contrast projections versus forecasts. Okay, so let's just write something down here. Okay, projections. Okay, what about projections? Projection is what if scenario. Somebody may want to talk to my computer that if it keeps this up, it's going to be retired. What if scenario just changed the battery in the thing. I rebooted. It wasn't working before. Okay, a projection is going to be a what if scenario. Okay, deals with the hypothetical. Okay, and is usually internal audiences. Now, when we say internal audience, we could be talking about inside the company, but we could be talking about somebody that we're negotiating directly with. Okay, now we want to contrast that a little bit with the forecast. The forecast is based on expected actions. And it is usually or can be used for external audiences or internal. Okay, so just flashcard and maybe contrast the difference between a projection and a forecast. Projection is a what if scenario, hypothetical. Usually it's with an internal audience or somebody I'm negotiating directly with. For example, let's say I'm going to open a restaurant and I am sitting there saying to the bank, if you give me the loan, this is what my financial reports will look like after the first year, my balance sheet, my income statement, whatever, right? Well, the what if there, the what if is if you give me the loan, right? That's a projection. That's dealing with a hypothetical and internal audience. And you say, well, how is a bank internal? Well, they're not, but there's someone I'm negotiating directly with. A forecast says I already have the loan. And now I'm going to go out to a set of general investors and see if they would also like to invest in my endeavor, say, opening a restaurant. Now, sometimes I've heard, and I think it is sort of a good analogy, the way to remember the difference between these two is that a forecast, what everybody can hear a weather forecast, right? It's on your phone, it's on the TV, whatever. Projection, what? It's only for those in the movie theater, right? Okay, so that's another way to look at the difference between those. Now, they talk about projection here, and they talk about how it's a what if scenario and whatnot, but then they don't really do much to talk to us about forecast, and we're talking about both here. So that's why I wanted to write that all in there. Okay. Now, sensitivity analysis says, well, what happens if we change one of the assumptions? How will the outcome differ when you change one of those particular what if type situations? Okay, so you can see that a what if scenario sensitivity analysis, what if analysis, is a risk management tool that is used to test the effect of specific variables on overall profitability. So you can flashcard that. Also flashcard, right, since we tend to have questions that look at pros and cons, in that when we look at sensitivity analysis, we're generally saying, well, okay, if this changes, everything else will stay the same and this will be the outcome. That's not reality, right? When you change one thing, generally other things change as well. Okay, so go ahead and flashcard that. Now, if you take a look, guys, and I'm not going to go through the detail of this example because all they did was said, well, what happens if sales change 25%? Then cost of goods sold will change proportionately. And then our general administrative expenses, we're assuming, will stay static, will stay the same. And this will be the impact on our profitability if we have a 25% increase or decrease in our estimated sales. Okay. All right.
John, sorry, I got booted out of my internet, but I'm back on now. Sorry.
Oh, okay. Hopefully it wasn't
No, it was my internet, but I just like restarted it. It's fine now.
Okay, all right, thanks. Okay, scenario analysis, okay? And basically what we're gonna talk about here with scenario analysis is basically assigning probabilities to different outcomes and then adding those probabilities together to come up with essentially what is an expected value for a scenario, and then seeing what we think the expected value will be once we consider the percentages of the different scenarios. So you take a look, optimistic, we're saying, hey, sales is going to grow 5%. Pessimistic is saying that sales will decline 5%. And then the most likely scenario is that there'll be no growth. Okay, so what we do is we go ahead and we take the sum of those probabilities, okay, 50% of zero growth, 20% of a negative 5%, 30% of a positive 5%, and then we go ahead and the expected value of the growth is 0.5, and if our current sales were 40 million, multiply that times 1.005 because we're maintaining the 1%, and we're going to have this 0.05, or I should say 0.5% growth. That gives us the projected amount, the estimated value of the sales of 40.2 million. Okay, all right, good. So just go ahead and flashcard what scenario analysis does, that we come up with the weighted totals, add those together, apply that to whatever we're looking at, sales, whatever, and then that'll allow us to come up with an expected value. Okay. Now we talk about forecasting techniques. Okay. Forecasting is driven by historical data and actual expectations rather than hypothetical assumptions, is what we see for projections. And they tell us what I actually already had you flashcard. The forecasting is generally for both internal and external, whereas projections are for internal audiences. So maybe you could flashcard it here if you want. I did already ask you to flashcard some of those points that we made about the difference between forecast and projections. Forecasting techniques generally can be broken into qualitative versus quantitative methods. Okay. Now, one that has been around for a while now and commonly used is regression analysis. Okay, and what regression analysis says is this: you look at a dependent variable, okay, say total cost. Okay, and your total cost then would get plotted on the y-axis, and then your x-axis would be the independent variable, and I'm going to just do it in terms of total overhead cost. Let me squeeze overhead in here. Okay, and then you look at an independent variable, say direct labor hours. Okay, and what regression analysis tries to do is say, look, is there a relationship between total cost, which is represented by this line right here, okay, total cost, the the dependent variable, and what? And the direct labor hours, which is plotted on the x-axis. As direct labor hours go up, does it make sense does it seem reasonable that our total overhead costs would go up? Okay, we're trying to do this because we're trying to determine what's an appropriate driver for our overhead costs, because remember we talked about in chapter 3 that we're going to want to do what? We're going to want to estimate what our overhead is going to be so that we can come up with a predetermined overhead rate so that we can apply that to work in process as jobs use up whatever the driver is, in this case, direct labor hours. Now, what you would do is you would plot a bunch of different observations month by month. You may have years of data, and these days with all the analytical tools that are available, you may be able to gather total, your direct labor hours and total cost over total overhead cost over a series of months, whatever. Now, what happens when I observe these points? Okay, if there is some sort of linear relationship here, the points should line up sort of the way I've drawn these little dots in here. Okay, now what happens? Notice the dots are not lining up on that line. So even though I'm saying that my overhead cost function is this line, they may or may not be lining up on that line. They may not be behaving linearly. And what regression analysis is going to allow me to do, it's going to allow me to statistically determine how close those dots are to that line. And the closer they are to that line, the closer that I'm going to be able to use this relationship as a predictor of my overhead cost. Now, if they don't line up at all, then what that's telling you is, hey, you have not selected the correct driver for your overhead costs. Maybe you should look at machine hours, or maybe you're going to have to use the activity-based costing type approach that we talked about before, in which you're going to have to come up with a driver per overhead pool. You might have to use multiple pools, etc. Okay, but the whole point of regression analysis is it's going to allow me to at least know whether or not this cost relationship, independent variable, direct labor hours to total overhead is a reasonably linear type of a model. Okay, so simple regression analysis, okay, has one independent variable, one dependent variable. Okay, whereas a more complicated, more complex version of linear regression would have several. But for our purposes, several different independent and dependent variables. For our purposes, so go ahead and flashcard the difference between simple versus more complicated, that would have more than one multiple regression versus simple regression. Multiple has more than one independent variable, whereas simple has just one dependent variable. Okay, now come over and let's just take a look at the application here. Okay, and let's just go ahead and again look at it in the context of our overhead cost model. Okay, so they give you this sort of mathematical equation for using linear regression, but notice, guys, we could turn this into a cost function by saying total, and again, I keep forgetting that I'm trying to put this in the context of overhead cost. Total overhead cost, I guess I'll write that out, total overhead cost, right, would be a function of my variable cost per unit plus my what? Times my number of units, say direct labor hours, whatever, plus my what? Plus my fixed cost. Okay, now when you look at this, the BX here is what? My variable cost per unit times the units. The A here is my what? Fixed cost, and obviously the Y is my total overhead cost. Okay, so you can see here when they talk about the application now, let's just look at this, and it says if Y is total cost, X is total activity or output, one goal of regression analysis would be to predict total cost, right? based on observed total activity or output. Okay. Now they say that questions on the CPA exam expect you to predict total cost, and I could see where that could cause you some amount of anxiety. I almost said angina. It could give you chest pains. Okay. If you're sitting there and you're thinking to yourself, well, geez, that means I'm going to have to do some sort of modeling and all that. No. What they would do is they would see, do you understand that if you have this kind of relationship where total cost is predicted by variable cost times the number of units plus fixed cost, and then they give you the components that make that up, would you be able to realize that that's talking about a total cost relationship, and you would be able to add those, plug in the numbers that fit with those variables accordingly to come up with a total cost number. So they're not going to make you do a regression analysis on the exam, so you can lay that concern to rest. Now, when you do a regression analysis, okay, there are a couple of things we're going to need to be able to interpret. One is the coefficient of correlation, okay? And the coefficient of correlation can range from -1 to 1, okay? Now, what happens? And you can go ahead and, flashcard this little table right here, okay? So what it's telling you that if the number is 1 or close to 1, then there's a positive correlation. As the independent variable moves, so moves the dependent variable, okay? If there is a -1 as your coefficient of correlation, that's telling you that they move in the opposite direction, okay? If it is 0, that's essentially telling you that there is no correlation, okay? So flashcard that, but when you look at it, you look at the graphic here, and that's what that's telling you is one moves, the other moves in the same direction. Units go up, total costs go up. If they're going down, then they're moving in opposite direction. As one goes up, the other goes down. And if it's a 0, that means there's no correlation. These things are jumping all over the place, depending on very random factors there, okay? So you take a look, and perfectly positive correlation is a +1 for the coefficient of correlation, okay? Sometimes I would say temperature and ice cream sales. Temperature and air conditioning use, right? The higher the temperature, the more people say, hey, let's go get some ice cream. The higher the temperature, the more people turn on their air conditioning, right? A inverse correlation says things move in the opposite direction. I don't know how annoying it is that now, as soon as they tried to open up the economy, mysteriously all the gas prices went up all of a sudden, okay? But when the COVID was first, shutting us down, geez, gas prices went down because nobody was buying people were buying grass, probably. Nobody was buying gas, okay? So what happens? Inverse correlation, as the number of COVID cases go down, gas prices, number of cases go up, gas prices go down. No correlation, I don't know, COVID to seaweed in the ocean. I don't know, there's no correlation between those, okay?
I have a question. If you didn't know something about the subject, how could you determine which was the dependent and which was the independent variable? Because if you actually flip the things on the axis, you'd show an inverse correlation. But if you flip, if you put the total cost on the x-axis and the direct labor hours on the y-axis, you'd show an inverse correlation, maybe. But I don't know. I was thinking to myself, how could you be sure that you picked the right dependent variable and the right independent variable? Maybe that's the wrong way to ask the question.
What you're doing when you do this, Kathy, is you're looking for data to support a hypothesis, right? Okay. And it's reasonable to think that if direct labor hours go up, the total cost would go up, right? Because we have more activity.
Okay.
And what this is doing is it is trying to tell you if that's the case, okay? And if you get something that's near 1, they're telling you, okay, proceed with what you're doing because it's behaving linearly, okay? This is probably telling you, unless you were trying to prove a negative correlation, this is probably telling you step away from the analysis. It's not working the way you think it is. Find another driver for whatever it is you're trying to predict, because it ain't this. In fact,
Okay, so this is actually used to, this is actually to test a hypothesis about relationships, right? You would already have an idea before you applied this, right?
correct.
Okay.
Correct.
Thanks.
Yeah. And, depending on how sophisticated you're trying to be with this, I mean, let's forget about accounting for a second. If I'm trying to see, what is the incident of blindness when I put this chemical in a pill, and I get this, that's telling me don't put that chemical in the pill. So, it really depends on what it is that you're trying to prove. What this is telling you is you've got, you really can't, goddamn thing. You my pen. You really, you have no idea. You just step away from this analysis now. You have picked the wrong, there's no correlation. You have picked the wrong independent variable to predict, the wrong independent variable to predict with this dependent variable. Start over. And you can do regression analysis in Excel these days, not on the exam, guys. But you can do regression analysis in Excel these days just by plugging the numbers in, and it'll spit out the equation for you. And then, of course, you have to know how to read the output, but this is a pretty common tool nowadays. And again, when you can extract, observations that go back years and months and months and months, then you're getting a pretty good chunk of data that's describing how one moves versus the other. Okay. Okay.
Thank you.
Yeah. Okay, good. Now coming over and taking a look, and we can use this again to project total cost. So when predicting total cost, the dependent variable is a function of fixed cost, okay, variable cost, and volume. And volume is the independent variable. And management, and here kind of, maybe I should have just kept going with the book to answer your question. Management's expectation the correlation coefficient will be somewhere between 0 and 1. If it's 0, there's no correlation. So I would disagree that you're thinking it's between 0 and 1. You're thinking it's closer to 1. Okay. Otherwise, why would you, if you think it's close to 0, why would you be doing it? Okay. Okay. Now that's the what? Coefficient of correlation, telling you how one moves, the other moves, right? Okay. Now, coefficient of determination, and let's flashcard that. That's trying to explain how much of the movement of the dependent variable can be explained by the movement in the independent variable. Let me make sure I said that right, because I have a bad habit of crossing those. Let me say it again. The coefficient of determination is telling you here how much of the movement in the dependent variable can be explained by the movement in the independent variable. And so what you do is you simply square the coefficient of correlation. And when you do, that will then give you a number that will be, and since we now have taken maybe that negative number and squared it, that will tell you how much of the variation is explained by the independent variable, how much of the change in the dependent variable is explained by the change in the independent variable. So let's just take a look. And they give us a bunch of stuff here, and we go ahead and we plug in the numbers and whatnot, and we get what we get. This R, the coefficient of correlation of 0.9. When we square it, we get 0.81, and when we get 0.81, that means that 81% of the variation of the change in the dependent variable is explained by the change in the independent variable. So that's a useful tool as well. Okay. Okay, question? All right, good. Let's go ahead then and look at this high-low method. Now, here's what the high-low method. The high-low method is like something you can use in accounting, because at the end of the day, what happens if we come up with a relationship, total cost equals our variable cost times our number of units plus our fixed cost, and we're using that to predict how our overhead costs move, but they don't really move in that manner. So we'll come up with a predetermined overhead rate, right? And we'll use a somewhat inaccurate predetermined overhead rate if we're using high-low method, which is not as sophisticated as regression analysis. What will be the outcome of that? So we sit here and we're going to use, God damn it. We're going to sit there and we're going to say total costs equal variable costs times the units plus fixed costs. And we use a method that is not very sophisticated. So we sit here and let's say we say our variable cost, I don't have to write BC again. Let's say we say our variable cost is $5. We say that our units are 100 to make the math easy. And we say our fixed costs are 1,000. So what do we, and let's say this is our overhead cost. What would we be saying our total overhead costs are then?
1,500.
Good. Total overhead costs, thank you, are 1,500. So then what would we do? Then what would we do? We would take that 1,500. We would divide it by what? By the projected units of 100, right? And that would tell me, and let's say this was direct labor hours that we were using as our driver. So every time, what's 1,500 divided by 100? 1.5? $1.50. Okay, so is that right?
15.
What is it?
Isn't it 15?
15.
Yes, 15.
$15. So what happens? So every time we incur a direct labor hour on a job, what would we do? We would debit work in process for $15. And we would credit what? Our manufacturing overhead for $15. Did I say debit? We would credit it. Okay. So here's my manufacturing overhead. I just credited it for 15. Now that's the apply, right? That's the amount that's going to work in process. Now, what's on this side, on the debit side? Note to self, look at chapter 2 homework because nobody's done it. What's on the debit side?
Manufacturing overhead.
Yeah, we've got the credits, which is the applied. Use the predetermined overhead rate, right? What's on the debit side?
Direct labor,
Huh?
direct labor.
Say that again?
I think she said direct labor.
No. No. Okay. Guys, if you don't do the homework and stuff, it gets kind of hard to keep building this thing. Okay, we have work in process, right? We just debited work in process. What goes into work in process?
Manufacturing overhead,
Why? Okay, that's,
and then that goes out to finished goods.
huh?
Well, then, but that goes out to finished goods, so I don't know, is it the raw materials?
Okay,
Conversion
good. Raw
costs,
direct costs such as raw materials. Okay, so materials. What else?
Labor?
Manufacturing overhead. Direct labor, good. Okay, so remember, guys, we add to our work in process our manufacturing costs. Remember that whole discussion?
Mm-hmm.
Okay, all right, good. So we debited our manufacturing overhead, and then as these things are done, we do what? We credit work in process, we debit finished goods, and when we sell the stuff, we do what?
Cost of goods sold.
Sold good, and we credit the finished goods, right? Okay, right there. Okay, kind of hard to tell what numbers well when they're all X's, but we draw some arrows. Okay, all right. Now, what's the debit to manufacturing overhead then?
Cost of goods sold.
Okay, accounting is not a guessing person's game, guys. Okay, cost of goods sold has been already been debited.
I think what's confusing is we've already applied the manufacturing overhead to the WIP. So, and isn't that this?
Okay,
I don't know.
we have the actual manufacturing overhead here. So we'd have our indirect.
Oh, okay. That's what you're going for.
Indirect labor, materials going here, right? The actual. So if we requisition some grease from the raw materials, we credit raw materials, we debit manufacturing overhead. And then there were the others. Remember, others were things like depreciation, for example. So we would debit the manufacturing overhead, we would credit the accumulated depreciation, right? Guys, we went over this in chapter 2. I'm not quite understanding. I mean, I understand why you maybe didn't know it first, but now that I'm refreshing, why are you not saying that's right?
I think it was it was maybe a little bit out of sequence because when you're taking it out of the credit side, you're putting it into WIP. And I think I think I certainly was confused by the sequence. So, because wouldn't you'd put the debit stuff in manufacturing overhead first, and then at the end of the period or whatever, you'd credit it out and it would go into WIP, right?
Okay, but if I ask you what the debits to manufacturing overhead are.
Okay, I see. Yeah, I just.
I'm with you, Kathy.
The indirect labor, the indirect materials, and the depreciation, the utility bill. I'm going to credit utilities payable. I'm going to debit instead of utility expense. I'm going to debit manufacturing overhead, right?
Yeah, I'm like, well, we're taking it out, why are we gonna put it back in? That's what I was thinking, but I got it.
I asked you, what are the debits? I didn't say what order would you put them in, okay? The point to this is that let's say my actuals are 16. Let's say I'm wildly wrong, okay? Meanwhile, back at the ranch, I was trying to just explain here why it's okay to not be perfect with what you're determining your predetermined overhead rate to be. Because let's say I debited 25. If I debited 25 in here for my actual, am I under or over applied?
Under.
I'm under applied, so what will I do? I'll fix it with a
Right.
pen. It hopefully would work. I would go ahead and I would simply credit the applied and I would debit. And again, I might spread that debit between what? Between the work in process, the cost of goods sold, and the finished goods,
Mm-hmm.
right? Okay. So my point here, and I guess we had to go through a little bit more than I had hoped for, but my point here is that it's okay if you're off. Okay. So whereas regression analysis is a more sophisticated way of doing this, you could use high-low. Okay. Now what high-low says, okay, is, where'd my high-low now go? What high-low says, just coming down to the example, is high-low says, okay, look, here's your total overhead cost. Okay, total overhead cost. Here's your independent variables, say direct labor hours. And you have these observations. Oh, God. I guess I have to write it down here. If I draw it to the near the top of the page, for some reason it doesn't want to work. So here's your total overhead cost. Here's your direct labor hours. And you have these observations. And what the high-low method says is I'm going to draw a line. And that is what I'm going to assume my function is. Now you look and you know those other lines aren't lining up on that high and low. They're not lining up there, but you sit there and you say, well, they are. And you use no statistics, no regression analysis to try to measure that correlation. You just say it's perfect. It's a 1 when you're sitting there using the high-low method. But it's okay that you do that. It's not going to be precise because if it's wrong, I'll just make an adjustment at the end of the period, right? For my under or over applied. Okay, so notice they give us the formula here, okay? And with the high-low method, and this is not a formula that I think you need to memorize or anything, because all it does is it's equivalent to y equals mx plus b, okay? Now, you remember that m is y2 minus y1 and divided by x2 minus x1, okay? But now all we've done is we have traded those for total cost high minus total cost low divided by what? I don't know what this one is, units, volume. We'll just say units high minus units low, okay, whatever those are, okay? So you look, and when you look at this example, they tell us that what? It would have been nice if they would have labeled the months, but that would have been too easy. So notice they tell us that what? The high month here is May, and the low month here is, where's the 3850? I mean, I see it's 8450. I see, I'm looking for the wrong number. 8450, okay? And notice the units so happen to correspond to that. Now, look, because this thing may not be moving linearly, you may have a situation where your high and low units and costs don't line up. For high-low method, you always look at the units to find your high and low. Okay, again, all that's telling you is this isn't lining up linearly. So what? We're just trying to get a rough approximation of how our overhead costs are moving. And then we're going to be able to make an adjustment at the end of the period by sitting there and adjusting for my under over applied overhead. Okay, so now when I pick those numbers up, I look at the what? I look at the total cost high. Okay, and where'd I go? Right here. Damn this thing. So irritating. I look at the what? Total cost high minus the total cost low. That gives me this difference of 1100. That's just like Y2 minus Y1. And then I go ahead and I do my what? I do my units high units low, and that gives me essentially that difference. Well, that's the slope of that line. 1100 divided by 400 gives me a slope of 2.75. The M, the slope, which is the way you calculate M, is my what? Is my variable cost per unit. Okay, now once I know what my variable cost per unit is, then, and I can either use the high or the low. Okay, I'm going to go ahead and just stick with the example here, use the example here where they use the high total cost 9550, and then they go ahead and they say, well, 275 times 1400 units gives me 3850. So they're saying 275 times the high number of units, 1400. Somebody check the math on that, please. Does that give us 3850?
Yes, Professor.
Okay, good, thank you. And so if this is my total cost and this is my what? Variable cost, then the difference must be the fixed cost, 5,700. You could do the same thing on the low because you're picking what? You're picking these 2 points and saying that everything lines up on that line, even though they don't. You can't use any other point in the observation because they're not lining up on that line, okay? So what happens? You then have an equation, and your equation is what? 5,700 plus 275. Somebody predict the units. We think we're going to do per month, whatever.
100,
I would say that's not a very
1,000,
Huh?
1,000. No,
Yeah, 1,000 would be okay, but let's go wild. Let's say 1,500.
okay.
Okay, they're just predicting what's going to happen. So what they're saying there, Kathy, is, hey, next year we're going to do more than we did in any month in the previous 6 months or whatever, right? Okay, and so when you do the math on that, 5,700 plus 275 times 1,500, somebody give me a number.
9825.
Huh?
9825.
9825, you say?
Yes.
Okay, good. If I want the predetermined overhead rate, what should I divide that by? I always like it. I'm like the pitcher that keeps throwing that same pitch at the batters and they strike out on it every time. I'm like Mario. When I'm teaching this, I'm Mariano Rivera. I pitch that one pitch that nobody can hit. How do I figure out the predetermined overhead rate?
Total budgeted overhead costs divided by the units.
Okay, so what do you want me to divide this by?
I'm trying to find it. 1 second.
Well, you just said it. You said
overhead
total projected overhead cost, which is what that is, divided by, why would 100 come in?
100?
Oh, 1,500, yes.
15.
Divided by 1,500, good. Divide that by 1,500, now that gives my predetermined overhead rate, doesn't it? Using the high-low method?
Sure.
Well, if you're frustrated and confused, it's because you didn't look at chapter 2. This was in chapter 2. All I'm showing you now is how to come up with the elements that constitute how to calculate the estimate of what your overhead is going to be using the high-low method. I mean, in the chapter 2, we said, well, your projected overhead is 9,825 and your projected units is 1,500. And that's how you come up with the predetermined overhead rate. And at that time, I think I said that we would be talking about how to make these estimates in upcoming chapters. That's what we're doing here. We could use regression analysis. We could use this high-low method. Once we have this number now, what is 9,825 divided by 1,500?
6.55.
6.55?
Yeah.
Okay. So Matt, if a job uses 100 direct labor hours, what would you do?
Multiply that by 6.55.
6.55, good, times 100 would be what?
655.
Thank you, 655, good. What would you do with that number?
That's the cost.
Someday I'm gonna get a license plate that says accountants do it with numbers. I have a number, what do I have to do with it?
To put it in work in process?
Good, I will debit work in process. I mean, we're not doing this because we're trying to, please our high school algebra teacher that we actually understood something. We're going to go ahead and debit work in process. What do you want to credit?
Overhead applied.
Good, manufacturing overhead. And by definition, I guess since it's the credit, that means it's the applied amount. Oh, I don't have to put X's. I know the number. It's 650, right?
Yep, 655.
655. Okay. All right, guys. So all I'm trying to do is tie this back to what we've talked about before. I don't want you to sit here thinking, oh, well, high-low method. Wow, that's fun. Let's do that and have a few beers and it'll be great. The reason that the accountant is bothering with all these observations and whatnot is at the end of the day, so I have a number that I can do what? That I can use to make a journal entry so I can move these costs through my accounting system. Okay. Question. Okay, good. All right, let's go ahead and
I did have a question. I'm sorry, I couldn't get my mute off. Is the cost that you're dealing with here, are these all overhead costs because that's what you end up allocating using this thing? Or, so what you're talking about is basically maybe the variable and the fixed component of the overhead? Is that what you were talking about? That's what we're allocating and that's why we divided the 9,825 by the 1,500?
It's going to have to be a function like this. So it doesn't have to be overhead, but overhead does that.
Okay.
Fixed component has a variable component, right? It could be that we are simply doing this for one element of our production that moves like this. For example, utilities tend to do this, okay? And that if you want to have electricity come into your house, PG&E is going to charge you $100 a month. I don't care if you sat there in the dark,
Right.
never moved, they're still going to charge you. If you get a cell phone, you never use the thing. Of course, nowadays everyone just pays this flat rate. But in the old days, you had to pay for the cell phone. And then as you started to use it, the amount went up. So utilities tend to work this way. And if you were trying to predict how utilities were going to move to kilowatt hours, then you could go ahead and use this high-low method. And maybe what you're going to do is have, to me, notice I'm still talking about overhead type things though, like utilities. So to me, overhead is the classic one that moves this way. And you don't have to have one single plant-wide overhead rate. You could use these methods to come up with overhead rate by activity, couldn't you? Like we talked about with the
Sure.
models thing in whatever chapter that was, chapter 3.
So you would use it, so the units would be your production units here. I'm just thinking in terms of practicality here, and the cost would typically be what your electricity, let's say you were analyzing a plant and you were saying, okay, what's my electricity cost at this plant? At this plant, here's our production volume. And this is the electricity cost that we had each month in that plant. And we figure some of it's variable, some of it's fixed. And so this is the exercise you'd go through to allocate that electricity cost at that plant, right? That's conceptually what you're doing here, right?
Yeah, but I would say that it's not necessarily widgets as much as it's kilowatt hours
Okay. Okay, so you'd be,
in that example.
okay, your units would be hours instead of hours and cost as opposed to production units, right?
Correct.
Okay.
For example, this, I said direct labor, it's hours, it's probably direct labor hours. It's probably kilowatt hours. If you're,
Okay.
if we were saying, well, we're not we're an outfit that is highly automated. Well, then I'd say direct labor hours is probably not a good driver for your overhead. I'd say you probably want to use kilowatt hours. And then again, depending on your activity, you may select several drivers for several different activities and apply those as a product or a service or whatever starts to use up those drivers. Okay.
Thank you.
Okay. All right, let's talk about learning curve. Okay. And when we look at learning curve, basically what we see is as we gain more experience with a particular process, we actually become better at doing that process, and therefore the cost of units as we produce more, or the amount of time, I should say, the cost. I guess if the time is money, right? As the number of times we repeat a process, the time it takes us to complete that process comes down. So what can happen is we can actually produce more units. We'll be able to produce our units faster as we move through that learning curve. Okay, so let's just go ahead. Oh, come on with the nonsense already. Isn't that wonderful? Okay, let me take that ridiculous color off of there. Okay, so let's just go ahead and let's take a look. And it's used to set standards, project cost, and units should decline until a steady state period is achieved. Once steady state occurs, then the labor will remain fairly constant. Okay, so in order for learning curve analysis to be applied, the activity must be repetitive in nature. Okay, so come over and you can flashcard that, but let's just go ahead and take a look at how we would measure productivity. And what I want you to do with this, or measure learning curve, I should say, what I want you to do with this is just go ahead and flashcard this example. Okay, and I think this gives you a good sense as to how to deal with any learning curve question. So it takes 50 hours to produce the first unit and 70 total hours to produce the first 2 units. So obviously that second unit took less time, right? So what happens? If it takes you a total of 140 hours to produce for 2 units, okay, and you divide that by 50 hours then to produce the 70 total hours for 2 units and 50 hours to produce the 2 units. So you get now 70 divided by 100. So you have a learning curve of 70%. Okay. All right. With all that, let's go ahead and let's take a look at a couple questions. Okay, let's go ahead and wrap this one up a little bit. And basically, this is a definitional question that almost looks like everyone got right. The answer here is B. The coefficient of determination, R squared, is what? The percentage of variation in the dependent variable explained by variation in the independent variable. Now, I think that some of us, one of us anyway, chose C, and that is what? That is R, not R squared. Coefficient of correlation measures, even though they didn't call it out as such, but that measures the proximity of the observations to that line that we're fitting to those observations. And I don't know what that drawing that my pen decided to put up just then was, but okay. Okay, good. Let's go ahead and let's try question 2. I'm giving you a little more time with this one, guys. Keep going. Okay, let's go ahead and wrap up. I mean, I've got 8 out of 17 people that were able to choose something here. So make your best choice here. Okay. All right, good. Guys, don't get me into the roll call mode again. Okay. Expectation is that you're participating. Okay. All right, good. So let's go ahead and let's take a look. And okay, pretty good result, although I have to say this is not a terribly difficult question, but it is maybe something that you need a little more practice with, and then you'll be good at it. Okay, so the answer here is B. Most of us got it right, but let's just go ahead and go through this one together. Okay, now what happens? They give me 2 observations, and they ask me to use the high-low method here, or I'm going to have to use the high-low method because they've only given me 2 levels of activity to look at. So I'm going to sit here and I'm going to say, well, if I have what? I have cost of 160 at the high, and I have what? Cost of 132, and since it's only 2, that's the high and the low, then I'm going to take 160 minus 132, and I'm going to divide that by what? By, again, this one's consistent, high and low, 80,000 minus 60. Okay, now when I go ahead and I do the math on that, I get what? 28,000 divided by what? 20,000. Am I doing my math right? Okay, and I end up with 1.40.
Yep.
Okay, 140. So that 140 is going to be my slope, right? It's what? Y2 minus Y1, X2 minus X1. It's the same thing as the slope. In other words, that becomes my what? Variable cost per unit. Okay. Now, once I've done that, then I can sit there and pick either the high or the low. Do you like to get high or do you like to be low?
All right.
Yeah, let's go.
Good. Okay, so what am I going to do? I'm going to take the total cost of 160, and I'm going to subtract from that the variable cost, and that's going to give me my fixed cost. And so if my variable cost per unit is 140, and since I decided Matt told me he wanted to get high. So I took the 140 times what? Times the high level of activity of 80,000. That gives me, what did I do? Not write it down like an idiot.
48,000.
48,000.
Mhm.
This number for the variable cost is 48,000. 140 times 80,000 equals
112.
112,000.
Yeah.
Okay, so my total cost minus my variable cost, now you're telling me that gives you 48,000, right? The difference. Total cost minus variable cost must be fixed cost. So now I've got a what? I've got an equation for my total cost. Total cost is going to be my variable cost per unit, which is $1.40, times whatever units they asked me to plug in plus 48,000. So in this question, then they asked me what? Plug in this 75,000 kilos.
Yep.
Which I did. And when I come to that, I get 153,000, the answer, I hope.
Correct.
Okay. Okay. So not a really difficult problem, but you probably want to practice with that more than once before you go into the exam. Now, here's the big prize. Predetermined overhead rate. Who's got it for me?
1.40.
1.40. I don't know. I don't think so. 1.40 is my variable cost per unit. I asked for the pre.
2.04.
I don't know where that number is coming. What did you say? Say it again.
I said 2.04. That is 153,000 divided by 75,000.
Good, thank you. I take the 153,000, I divide that by the units that they told me in this problem, 75,000. That means that this company has a predetermined overhead rate of 2.04, give or take. Matthew, 1.4 is the variable cost, right? Not the predetermined overhead rate. And that's an easy mistake to make.
You're right.
Okay. Question. There is absolutely no reason to miss these questions on the exam. None. There is no excuse to miss a question like this on the exam. You've got to get these right. This is like playing, chess against your little brother. Okay, you win that game. Okay? Okay, good. All right, let's go ahead and let's take a look at Module 2 after the break. I'm showing about 6:27. We'll go ahead for round numbers sake. We'll come back at 6:40, okay? I'm going to pause the recording, guys. Don't forget to keep me honest to turn it back on. Okay, guys, let's go ahead and jump into Module 2. And we're going to start talking about cost, volume, profit analysis here. The most common cost, volume, profit analysis that you've probably heard of is break-even analysis. I'm sure you've heard of it, but we're going to look at some others as we move along. Now, one of the major things that we're going to need to understand is what costs are variable versus fixed, okay? So variable cost, and let's talk about product cost first. What are our product costs?
Manufacturing overhead, direct labor, direct materials.
Good, direct labor, direct materials. Good, Matthew. Would you say those are variable or fixed?
Those are variable.
Good. Those are going to be variable because the more units you produce, whatever, the more labor, the more materials you'll need, at least direct. Okay, good. Then you said manufacturing overhead, right? Okay. Now, when we look at manufacturing overhead, some could be what? Could be variable in nature. For example, my utility bill is probably going to be based on the number of units, although there could be a fixed component to it as well. Are there any manufacturing overhead costs that you think might be fixed?
Rent.
Good. For example, rent, utilities, those sort of things, right? So when we look at our manufacturing overhead costs, those tend to be more fixed in nature, right? Now, what happens when we are tracking costs? We're going to have our work in process. And what's going to go into work in process?
Direct labor, direct material, and overhead.
Direct labor, direct material, and the manufacturing overhead. And then, of course, not the point of this discussion. Well, I guess it's the point of this discussion a little bit. Manufacturing overhead, of course, would have been applied, right, to get into work in process. Okay. Now, what happens? Once we have finished this job, we will do what? The cost of goods manufactured will come out of work in process and we'll go into finished goods, right? And out of finished goods into what? Cost of goods sold. Good. Okay. Okay, good. Now, when we look at this, then we know that what? Our finished goods inventory, our work in process inventory is going to be constituted of what? Of these variable costs, but also it's going to be constituted of this manufacturing overhead as that moves over. So there will be some both variable and fixed costs in our finished goods inventory in our work in process. Where do we report work in process and finished goods? What financial report?
Say balance sheet.
Yeah, they're inventory items. They have future economic benefit. Good. These are reported on the balance sheet. Cost of goods sold goes where?
P&L.
Income statement.
Okay. Goes on to the income statement is where cost of goods sold goes. Okay, good. So what happens? We have some variable cost and we have some fixed cost. Before we sell the item, those variable manufacturing and fixed manufacturing costs appear on the balance sheet. And then when we sell the item, it goes to the income statement, right? Okay. How about selling and administrative expenses?
This is a period
Income statement.
Good. Selling and admin, not that there would be one account for those, but selling and admin, what would go straight to
The
my
income statement.
income statement? I guess I better put my income statement over here because I'm running out of room over there into my income statement. Okay, good. Could there be variable and fixed selling and administrative?
Yes.
Mm-hmm.
Yeah, a variable selling expense might be commissions.
Commissions, yeah.
Yeah, a variable admin might be a fixed admin, excuse me, might be the CEO salary. Okay, good. Now, this is going to become important because notice, guys, that what? Our fixed and variable manufacturing overhead costs do what? They sit on the balance sheet until we sell the stuff, right? Whereas all of our selling and administrative expenses, whether fixed or variable, go straight to the income statement. Okay. So what we're going to see is there's the absorption approach, which I just described, versus a contribution approach. Okay. And what contribution approach is going to do is treat fixed overhead as a period cost. Okay, what I just described to you, all this up here, was the absorption approach. The contribution approach is basically going to take my fixed overhead costs and treat them as a period expense. In other words, we're going to take all of our fixed costs as a period expense, and then we'll be able to calculate what different things using contribution approach, like my break-even analysis, etc. Okay. Now, absorption approach is what I just described. That is US GAAP, used for external reporting. I'll write it down here. When you pick up a company's financial reports, they're using the absorption approach that we just talked about. Contribution approach is not US GAAP. It is used for internal purposes. And we use it for internal purpose because it is good for decision making. I'm just gonna say good for decisions. Okay. Now, if you want to, you can flashcard that yellow and that blue and what I wrote around it. Although, frankly, it, is something that you might already just kind of know already. Okay. Okay, good. Now let's just come over and let's take a look at the absorption approach here, which again, we've said is GAAP. Okay. And notice that for the absorption approach, okay, we have revenue less our cost of goods sold. Are there variable costs in our cost of goods sold?
Yes.
Yes.
Okay, so there's variable costs. Are there fixed costs in our cost of goods sold?
Possibly.
Well, why wouldn't there be?
Yeah. There would be some fixed cost in there.
Yeah, unless we didn't have any fixed costs. But if we have fixed costs, there will be some in there, right? Okay, probably they're getting applied through the overhead. That gives me my gross margin, less operating expenses. Okay, so we're just going to say selling and admin. Those could have what? Variable
And fixed.
plus fixed, right? And then that will be our net income, which is reported GAAP. So where were these cost of goods sold sitting before they ended up in cost of goods sold?
It's a balance sheet.
They're on the balance sheet, they had resided for a second, maybe in they had resided for a minute in the process, but what I'm trying to say here is they were unfinished goods, and then they went to cost of goods sold, right? So if there are any fixed costs, there would be in our cost of goods sold, they could have been on the balance sheet before we sold those items, right?
Mm-hmm.
Okay. Okay, good. Now, what we do with the contribution approach, because what the contribution approach says is, I don't care if it's a product fixed cost or an admin fixed cost, we're going to take all fixed costs and treat them as though they were a period expense. So what we do is we take our revenue minus our variable cost, then we're left with what? A contribution margin, and then we take all fixed cost. So all fixed costs mean what? Our admin fixed cost. What other kind of fixed cost can we have?
Rent,
Okay,
Mm.
don't be that specific.
Are you just going with like product costs?
Our fixed product cost. Let's say product cost as well, our fixed product cost. So notice what we're doing, guys. We're not letting our fixed product costs sit in cost of goods sold. We subtract them immediately in calculating, and they're putting net income. Sometimes I see it called operating income. So what happens? If you're in a situation where under absorption, under full GAAP accounting, you're sitting there and what? You have some costs still sitting on the balance sheet, those fixed costs that are still sitting in finished goods. You would have what? You would have a lower net income under the contribution approach, because now what you've done is you've gone and you've subtracted the fixed manufacturing overhead cost. And as a result, you have a lower net income if your inventory levels have gone up. If your inventory levels have gone down, what happens? Well, now we're sitting there and we have costs that we have already taken in a previous period, the previous period, as an expense. Now we're doing what? Now we're not having to take those costs under the contribution approach because we already took it. So if my inventory levels go down, my what? My variable costing is another name for contribution. My contribution approach will have a higher operating income. If I sit there and I do what? If my inventory levels stay the same, there'll be no difference between absorption and contribution. So you come over as a
I don't think I got that. You would have a balance sheet with contribution margin? I mean, isn't this just for internal budgeting and stuff like that?
Well, it's internal budgeting, but I haven't taken when you say you didn't get that, I don't know if you meant you got didn't get the whole thing or the last thing that I said, but the variable cost would be taken here, okay? And I would have already taken the fixed manufacturing overhead cost in another period if my inventory levels went down, so I don't have to take them again. Meanwhile, under absorption, I'd be taking them for the first time as they came off the balance sheet and went to the income statement, right?
Yeah.
Okay. So,
yeah, okay. Just have
So-
to sit with it for a little bit.
yeah. So if you take a look, the difference between absorption approach and the contribution approach is the treatment of what? Fixed factory overhead. Okay. Selling and administrative expenses are period cost under both methods. So the only costs that get treated differently under the two methods are the fixed manufacturing overhead costs. Under absorption, we're not going to take them to the income statement until what? Until we actually sell those items. Under, again, they call it contribution. Why don't you go ahead and put a variables in case the exam uses the term variables, okay? Then we would take all our fixed costs and expense them immediately and calculate our contribution margin, okay?
So I'm still a little bit hazy on that difference there. So then the difference between the two is really just the treatment of manufacturing fixed costs, right? Or is it all,
Correct.
because that's the stuff that will end up in inventory, correct?
Under absorption, but not under variable,
Under contribution or variable cost or direct cost or whatever they call it.
correct.
So, okay,
So this is my finished goods. I will probably have a heart attack tonight, I'm pretty sure. Because, okay, so this is finished goods. Here, okay. Here's my finished goods. Okay. And here's my cost of goods sold. Okay. Now, under absorption, and I'm just going to focus on fixed costs. Don't worry about variable costs right now, fixed costs. Okay. So I have $100 of fixed costs sitting here. And I don't sell the item. So what is my cost of goods sold going to be?
0.
Nothing.
0. Good. So my cost of goods sold is 0 because I haven't sold those things. And so my revenue is 0. My cost of goods sold is 0. And so I'm just going to go ahead and I'm going to ignore selling and administrative expenses. And so my net income is what?
0.
Right. Okay, good. Now, what we would do under the contribution approach is we would say, well, revenue is 0. Why? Revenue is 0. And now instead we would just simply say our variable cost are 0. My contribution margin is 0. My fixed costs are what?
100.
100. So I have what? I have a negative net income. And the difference between the, the absorption approach and the contribution approach is what? The contribution approach is showing a lower net income by the amount of fixed overhead costs still sitting on the balance sheet, right? Under absorption.
So then you're not recognizing expenses when incurred under contribution?
What expenses? What expenses? I'm not recognizing the manufacturing overhead that is still sitting in finished goods under absorption. Here, I'm treating those fixed costs as a period cost. I'm showing a negative. This is net income. I'm showing a negative net income.
Okay.
I'm showing a net loss of $100, and it's the fixed manufacturing overhead cost
Right.
that I take as a period cost under contribution margin approach, right? Under contribution approach, right? See the 100? That's fixed cost. Okay, here I'm treating it as an expense, right? And that's what's driving negative 100. And the difference is I'm showing lower net income. I'm showing a net loss under the contribution approach. And the difference is the amount of manufacturing fixed costs here, right?
Yeah, I'm still really confused about the timing now. So you have to sell it to recognize the cost?
Under absorption, under GAAP, yeah.
Okay.
Under the matching principle, yes. I don't take it until I sell it. Whereas under contribution approach, I'm taking it immediately in the period that's incurred.
Okay.
Okay, now, then what happens? Then, and I guess we'll go to year 2 here. In year 2, I sell the thing. I don't produce any more inventory. So I sell the thing. So now out of finished goods comes what? Comes the inventory and the fixed manufacturing. I go to cost of goods sold. I debit cost of goods sold for 100. Okay, my revenue, which is kind of silly because if you sold the thing, we have some revenue, but I'm trying to just isolate the fixed cost here.
Yeah. Mhm.
You would have cost of goods sold of 100. Okay, and so now just ignoring any administrative costs, my net income is a negative 100, right?
Right.
Under absorption, under contribution approach, I already took that
Okay.
last year as a period cost. So under absorption now I've got revenue of 0. I've got what? I've got variable cost. Again, I'm just trying to isolate the fixed cost. I got a contribution margin of 0, and fixed cost is 0 because I already took that fixed cost. I took it last year. I don't have to take it again. I took it last year when it was incurred. So now my net income is what? Now my net income is 0. So now what's happened? Now absorption shows a lower net income, and the difference is what? Is the fixed manufacturing overhead. And since my inventory level went down, my absorption shows a lower net income. Okay, so what the exam is going to expect you to be able to determine here, and you can look at the difference, and the difference is what? How we treat the fixed manufacturing overhead. It's a product cost here. It's what? It's a period cost under, again, variables, direct, contribution margin approach, whatever you want to call that. Okay, so let's just go ahead and let's jump to the effective income, because that's where the exam is going to focus us. Okay, so if production is greater than sales, will my inventory levels go up or down?
Up.
If my production is greater than my sales and inventory levels go up, and if inventory levels go up, then what's going to happen? Then absorption will have a what? Will have a larger net income than variables, contribution margin approach, whatever you want to call it, right? Those are synonymous terms. Right? If my sales are greater than production, will inventory levels go up or down? Not a trick question.
Down.
Down.
Good. Then my inventory levels go down. And if inventory levels go down, then what? Then my absorption, I'm going to call it abs, guys. My absorption net income will be what? Will be less.
Lower.
Good. Than variables. And it will be what? It will be less than the what? It's consistent. The amount of fixed overhead, as we saw in the example. So not only do I know which is bigger, which is smaller, I know how much it is. It's by the amount of the fixed manufacturing overhead cost. Okay. If there's no difference, where's the no difference? Well,
The first item on the pass key.
okay, well, screw them. They should have wrote it down here. Okay, I don't know why they didn't write it down here. Oh, I see. You got
The
it.
next page.
Oh, okay, good. Okay, good. Let's go ahead and let's go to that next page. Thank you. Okay, if there's no change, and that's where we can put the flashcard. If there's no change, then what? Then there'll be no difference between the variables and the, contribution approach, whatever, and absorption. There'll be no difference. So you can flashcard that right here.
I'm sorry, this
Okay.
may be a silly question, but what is the approach to? The approach to the income statement, I guess? What's
What
the,
is the approach? The difference between the two?
no, I mean, it's called contribution approach, or what was the other one called?
Well, absorption is GAAP.
Okay.
Income statement, revenue minus cost of goods sold equals gross profit. Selling and administrative expenses equals net income. Contribution approach is used for internal purposes because what happens? If I take my revenue minus my variable cost, what am I left with?
Fixed cost.
I'm left with my contribution margin.
Oh, contribution margin, sorry.
Then my fixed cost, I'm going to be treating as an expense, and my fixed cost would show up as 100,000, whatever, right? And so, and then here's my net income. Okay, whatever it is, let's just say negative 100,000. So Matthew, this is good for internal purposes because now I can start to tweak this number. Let's say I had a positive contribution margin. Let's say my contribution margin was 2 million, let's say. And my fixed costs are 100,000. So my net income is under absorption is 1,900,000, right? Okay. And let's say that I say, well, I'm going to take on an advertising campaign. It's going to cost me 50,000. Okay. But when it costs me 50,000, I'm going to increase my sales by 70,000. Now it should be obvious to you, okay, yeah, go ahead and do that. But let's just take a look what would happen, why it allows me to kind of do different things. 2,070,000. My fixed costs have gone up, what? To, how much did I say I was going to spend for that?
50,000.
So my fixed costs have gone up to 150,000 because I'm spending the money on the advertising campaign now. And so now my net income went from 1,900,000 to what, 1,920,000 if I'm doing the math correctly and on my head, which I generally don't. Right? So this is a good option. Now you sit there and say, well, John, why do you need a whole different setup of the income statement for these kind of analysis? You could have done that in your head. Well, look, sometimes there's a lot of moving parts to this, right? And so this approach allows me to quickly see what the outcome is going to be in net income by different options. That's why they use that internally. That's why I say it's better for decision making.
Okay.
Okay. Okay. Now, benefits of absorption. Okay. IRS requires the absorption method. GAAP requires the absorption method. So if you are going to start doing this, you're generating what? A whole new set of internal reports, right? So that increases your accounting burden. Okay. Limitations, the level of inventory affects net income. No kidding. Well, why shouldn't it? I mean, if inventory is still sitting on the balance sheet, I don't know why that's a limitation. Okay. And net income reported on absorption is less reliable under the variables method because the cost of production includes fixed costs and therefore level of inventory. So what? It should, okay. Go ahead and flashcard these. I don't know. I think somebody was smoking pot when they wrote those limitations, but so what? I mean, we do that all the time in GAAP. We leave certain costs on the balance sheet because the future economic benefit of those things hasn't expired yet. And we've all accepted that. So I think they were struggling for limitations there. Look at the benefits of variables direct contribution. Variable and fixed costs are separately and can easily be traced to contribution controlled by management. That's it, guys. Just flashcard that one benefit. I think and don't flashcard these limitations. This is nonsense. Don't flashcard that. I don't know what they're thinking. Okay, limitations, variable costing is not GAAP, and the Internal Revenue Service doesn't accept it. Go ahead and flashcard that as a limitation of variables. Okay. Question. Okay, good. Let's take.
You said don't flashcard the absorption limitation, right?
Not under, yeah.
Okay.
I don't know. Why is that a limitation? I mean, that's something that we've accepted in GAAP, is that we have a matching of the revenue and the expenses. And if we still have future economic benefit to be realized on that, we leave it on the balance sheet. Why is that a limitation? Why is that unreliable? I don't understand what they're saying there.
I think it depends on what you're using it for. I think that GAAP is more informative for an external person who's trying to figure out if you're making money on your products, period. I think for internal purposes, absorption costing may be less reliable because of you've got a lot of things you can't control or that the unit manager might not be responsible for that muddy the determinations that you have to make internally.
Good, write that down, because that's not what that says. That's a limitation.
But I mean, does that make sense? Have I kind of got that?
Yeah, it's not as, I mean, what the limitation should be, it's not as useful for internal decision-making as the contribution approaches. I mean, that's the limitation, not these other stupid things. Okay, good. Let's come over and let's take a look, and let's now start to talk about how we can use the contribution approach for some analysis, okay? So let's take a look at break-even analysis, and let's just look at the facts here. The following information is applicable to Greengrass Industries. Sales price is $125 per unit. Variable costs are $50 per unit. The contribution margin per unit, therefore, is 75. Okay, guys, if you're unclear on that, sales price minus variable cost equals contribution margin. And if you want that per unit, you simply do what? You simply divide your variable cost by the number of units, and that gives you the contribution margin. Okay, notice it's units what? Sold. We're using units sold for that. Okay, now fixed costs, they tell us in this example, are 150,000, and then they tell us there's a desired pre-tax profit of 60,000, tax rate of 40%, and so there's a desired after-tax profit of 36,000. And potential sales of 2,500 at the current sales price, a maximum of 3,000 units to reach market saturation, whatever. Okay, I don't know that we need all of this information, but let's first take a look at break-even point in units. And I'm going to tell you to flashcard this, okay? But think about it this way. You have what? You have your contribution margin per unit. Okay, you're going to multiply that contribution margin per unit times the number of units you sell. And if that equals fixed cost, have you broken even? Have you broken even?
Yeah.
Okay, I mean, let's think about this. Contribution margin first covers what?
Fixed cost.
Fixed cost. And then what? Then profit. If there's any contribution margin left over, once you've covered your fixed cost, any difference is going to go to profit. Okay, so if you do the algebra on this, you simply do what? You simply divide both sides by the contribution margin per unit. Doesn't that give you the break-even point in units? Guys, that's just a simple algebraic manipulation. I divided both sides by contribution margin per unit, didn't I? Okay.
What? The
What?
both sides of what?
The equation.
Okay, got you. That equation. Okay.
Yeah. So you take a look, and using the information that they gave us, and what happens, the contribution margin per unit, they had told us was $75 per unit. They told us that the sale in units was going to be what? 2,000. And that had to cover fixed costs. And they told us the fixed cost was what? 150,000. I'm just doing this right here. Okay. So if you divide what, actually, I don't know what the sale in units is here. I don't know why I don't know. The sale in units is the thing we're trying to solve for here, right? Okay, so 75,000 times $75, I should say, times sales in units, whatever that is. Then you take what? Then you divide both sides by the contribution margin, right? And so they determine that you have to sell what? 2,000 units to break even. Okay. Question? What?
No.
No. Okay, that was no good. Okay. Now, if you want to turn this into dollars, just simply take the break-even point that you just calculated times the unit price, and that will turn that unit number into a sales dollar number. And so that's all they did here. They said, okay, well, if I'm selling the thing for $125 each and I have to sell 2,000 to break even, then my break even point in sales dollars is 250,000. Then you come over and you could just have that number come out in dollars automatically by using the contribution margin ratio. Okay, so contribution margin ratio, and I don't like the way they did this because they put all the facts up here at the beginning and then I have to go back. Contribution margin ratio is 60%, okay, which basically is taking the contribution margin and dividing that by the sales price. That's telling me that what, 60% of each sales dollar goes towards contribution margin, right? Okay. So now, if that's the case, you take what? You take your you look at it as contribution margin ratio times break even sales dollars. That says break even sales dollars. Break even sales dollar has to equal fixed cost. So you do the algebra, you come up with what? Break even point in sales dollars. You simply divide each side by the contribution margin ratio. And that's what they did here. They took that 60% and they divided it by into the fixed cost. That gave me the same answer that I got by taking the contribution margin times the break-even units. I get the same answer. I mean, excuse me, the sales price times the break-even units. I got the same answer. Question? Now, nobody goes into business to break even. Everybody goes into business to do what? To do better than break even. And we've already said that the contribution margin first goes to what? First goes to fixed cost, and then any contribution margin that's left over goes to what? Profit. So now if you take the contribution margin per unit and you simply add on the desired profit, that gives you what? That gives you the sales in units now, not to break even, but to meet a target profit. So the only thing that changes here, and you can flashcard this, is you're just simply going to add the target profit onto the contribution margin. Onto the fixed cost, excuse me. And that's what they did. They said they wanted a $60,000 profit. They divided that by the contribution margin. And it shouldn't surprise us that you have to sell 2,800 units to now generate a profit versus the 2,000 that you needed just to break even. How much profit would you like out of this endeavor, Matthew?
$1 million.
Okay, I like that. So I'm going to take the target profit of $1 million. So now I've got what? I add those two together. I got 1,150,000. I divide that by the contribution margin per unit. How many units do I need to cover your profit needs? How many units?
1 second, I'm doing the math.
Okay. I can't wait. I'm so excited.
15,333. Sorry, 15,333.
15,333. Okay. Now look, that's quite a jump in units. And if you're saying, man, I'm not getting involved in this unless I'm making $1 million off of it, and you're trying to sell 15,333 jelly beans, then maybe you go for it. If you're trying to sell 15,333, high-priced pieces of art or furniture or computers or something, then you start to look and you say, no, I can't. I'm going to go into another business because this ain't working for me, right? So again, the point of the contribution format, once we got the contribution margin, right? And we can sit there and start to make these sort of decisions about how many do I need to break even to cover my fixed cost. All of these analysis, the point of the contribution approach, are much easier when you have your financial report laid out that way, right? Okay. Okay, good. Now, if you simply wanted that, what happened? Sales unit for contribution margin per unit. Oh, I see. Okay, I'm going to just go past that because that's stupid. Okay, let's come right here. Okay, right here. Okay, what happens? You could automatically turn that into a dollar amount by doing what? By simply adding the profit to the fixed cost and now dividing by the contribution margin ratio. Just like we saw earlier, that's going to turn that number straight into dollars, right? Just like we saw for the break-even analysis, you can do the same thing. Just simply add the pre-tax profit to the numerator. Okay, good. Now come over and let's take a look. And there's really not that much to flashcard here. I think it's good to go through this example though, to see how we can sort of use this approach to do some quick calculations. So we'll have a calculate green grass profit. If it sells 2,500 units. And so we are looking and we know already that our break-even point was the 2,000 units. So if we sell 2,500 units, that means that the 500 units now are going to go to profit. And so the contribution margin first goes to fixed cost, 2,000 covered our fixed cost. The additional 500 units will all go towards profit. That means that our profit will become 37,500. So the point of this example here starts to show you how you can use that contribution margin, and it almost becomes like an elevator discussion at some point where you're sitting there saying, well, look, since we break even at 2,000 and our contribution margin is $75 per unit, hey, Joe, quick on your calculator, on your phone, what's the 500 times 75? Okay, that's going to give me 37,500 more of profit. And if to sell those 500 more units, you know, Jeff over here is saying, well, he wants to spend 40,000 on an advertising campaign. We're quickly hitting the, you know, floor button and telling Jeff to get out on the next floor because we don't want to talk to him anymore, right? So you can sit there and make some quick decisions about, well, am I going to go for this? Well, what would be the effect? Well, I think you can sell 500 more units. Well, that's only going to give me 37,500. Why am I going to take on an advertising campaign of 40,000? Okay. Okay, good. Now we also have this idea of margin of safety. Okay. And so margin of safety is basically saying, hey, how much above my break even am I? And it is simply your total sales dollars minus your break even sales dollars is going to give you your margin of safety. That's just basically calculating a cushion. You can go ahead and flashcard that. Okay. If you want margin of safety to be a percentage, you simply take that margin of safety you just calculated, you divide it by the total sales, that gives that, it turns that obviously into a percentage. Break-even charts, guys, just look at those very quickly. Okay, this is the profit area here where what? There's my cost line, my total cost, fixed cost, variable cost. Here's my sales line. If I don't sell anything, I have zero. As I sell more units, that goes up. Once my sales are in excess of my total cost, I have profit, right? Down here, I've got what? I've got loss. Okay, so, you know, they could tell you, well, on the break-even chart, what point is loss, which part is profit? I don't know, but they'd ask you that. That's almost too easy. Okay. Okay, good. Now you could also come up with a target cost and you kind of work backwards. Target cost is going to be whatever the market price is minus your required profit. That's what you're going to have to charge for that. You know, I look at something like that, I'm like, oh, okay, anything else you want the world to give you? Okay, so, you know, you're probably going to have to sit there and control your costs to be able to get that required profit. I don't think that you can just charge whatever you want for this. You know, this looks like a defense contractor's way of figuring out what the cost is of something. You know, whatever we spend on it, we automatically get a profit. They call those cost plus contracts, cost plus a certain profit. And that's why defense contractors go crazy sometimes with what they charge for things, because they know they've got a guaranteed profit coming out of that. I was on an assignment one time with the GAO. We were looking at Lockheed Missiles in Space in Sunnyvale. So you go over there and you walk into the cafeteria and there's a dude with a big chef's hat cutting prime rib. Would you like a piece of prime rib, sir? It's only going to cost you $3.20, you know? Like, wait a minute, what is this? Yeah, they charge up those kinds of things because they know that they've got a profit. So yeah, go ahead, allocate all kinds of overhead to all these defense contracts. We know we're going to get some sort of profit anyway on those things, and we're living life large during that whole time. Okay, come over and let's take a look at implications of target costing and which I've already kind of covered those, right? Increase marketing and downstream costs, okay, to attempt to differentiate their product, increase complexity for cost measurement, and you're going to have product redesign to provide reduction of cost throughout the life cycle. Okay, so I guess they're kind of owning up to some kind of responsibility there. Okay. Okay, good. Come over I guess what they're saying against all the comments I made is that this is not very realistic, that you're going to have to sit there and try to keep that number under control. Okay. Okay, good. Let's take a look at a couple of multiple choice questions. Okay, guys, let's go ahead and wrap this one up and take a look. And okay, good. Most of us got it right. I'm a little concerned with some of the choices here, though, because I'm not sure why you would think that, but most of us got it right, B. But let's take a look at this one. And break-even analysis assumes unit revenues are nonlinear. No, it doesn't. We saw that what revenue goes like this, that's linear, okay? For the more unit, well, it would be linear if my pen wasn't a piece of crap, but that's supposed to be a straight line, but the more units you sell, the more your revenue, right? Unit variable costs are unchanged. Total variable costs change, but unit variable costs are whatever we've determined in our calculated contribution margin, $250 per unit, whatever it was, right? So that's why that's the answer. Unit costs are unchanged, okay? Total costs, no, my total cost line changes because of the variable component. As I produce more units, my total costs go up, right? Right? So total costs are not unchanged. Total fixed costs are nonlinear. And I guess the problem I have here, and that's not the right answer, this I guess means that this is not linear. I mean, I don't know. Now I have to become a geometrist to answer this question. I guess if the line is straight like that, that means it's not linear. It's certainly a line though. But look, clearly, okay, unit variable costs are unchanged is the correct answer. Whatever it is per unit, that's what it costs you. That doesn't change as you produce more units. Okay. Okay, good. Let's go ahead and let's take a look at this one. I'll give you a little bit more time with this one, guys.
Did you put the poll up yet?
Yeah. It's not showing on yours?
No, I'm not seeing the poll.
It's right in the middle of my screen, and I'm getting votes coming in.
You should see it on the bottom. It says polling, like next to record and share screen. Towards the
I see
bottom.
reactions. I see participants.
You don't see polling?
Nope.
Oh.
Well,
I think you're seeing that because you're a host, Amra, because on mine, oh yeah, I see polls down there, but on mine, it automatically comes up.
so I can't vote because I don't have a poll.
Okay. Well,
Sometimes because of the internet, it's lock you in and out, and then you lose the poll. Just
Oh,
do you want to tell us verbally your vote or no?
well, I would go for B, but that's probably wrong.
Okay, well, no, that is correct.
I got B.
So, yeah, so B is correct. Okay, and 80% of us got it. So that's good because I think we worked a little bit on this. So it looks like it helped. Okay, so let's just go ahead though, and let's do this one together. But the correct answer is B. Okay, and they asked me here, total contribution margin. Contribution margin is what? Sales price minus variable cost. That's it. Okay, so we take what? Now the hard part is getting your pen to write. But we take 80 minus all the variable costs, and they listed them for us. Very nice. Direct materials, direct labor, right? Variable manufacturing overhead, yes. We take that in calculating contribution margin. Variable selling and administrative, yes, we take that. We don't consider any of this fixed cost information here. They're just to mess us up, right? So when we do all that, what do we get? Did you get $40? Contribution margin per unit. Okay. And then they say to us, well, they sold, you got to use the numbers of units sold to get the contribution margin, right? Because that's what's hitting the contribution format. Income statement, sales minus variable costs, right? So you have to pick up the units sold, and that's going to be the $40, and that gives us 180. Okay. Okay, good. Let's take a look at the next one. So I'm putting up the poll. You should be seeing it on your screen
now
now.
I see it. Yeah. Okay.
You might have lowered it by accident or something, or it just didn't come up. So
I don't know. And every once in a while, my internet flickers. So
yeah. I've had a few flickerings tonight. Okay, guys, let's go ahead and wrap this one up and see how we did. Make your best choice. And I guess we have to move that up a little bit. Okay, and most of you got it right. Okay, about 80% of us, which is good. Okay, now the answer is A. Okay, but let's just go ahead and take a look. Most of us got it right, about 80% of us. Okay, but let's just take a look at this. So at the end of its first year of operation, 2,000 of units of inventory are on hand. So if I start my year, if I start my business, how many units of inventory do I have? 0. By the end of the year, I have 2,000. So did my inventory go up or down?
Up.
My inventory went up 2,000 units. Good. Okay, so I know that what? Since my inventory went up, when you look at this question, they're asking me about absorption versus variables. And they kind of told me that what? The use of absorption rather than variables would have a higher net income. So, you know, that knowing that it's going to be higher isn't that helpful at this point because they just give me numbers that would be higher. So then I have to look and they tell me that the fixed manufacturing costs are what? $30 per unit. Well, those fixed manufacturing costs are going to be treated as a period cost under variables, where under absorption, that'd still be sitting in my finished goods, wouldn't it? Okay. So I have to take that $30 per the number of units that have increased. That gives me what, the 60,000? Okay. So when you look at these questions of absorption versus variables, okay, at the end of the day, guys, it comes to what? Did the inventory go up or down? And what? What is the fixed manufacturing overhead per unit, whatever? That's how you're going to calculate the difference between the two. Okay. Okay, good. Let's take a look at this next one. Quick hint, guys, since it's asking you break even point in units, okay, that means that what? Fixed costs are going to have to equal the break even in units, which is what this question is asking for, times what? Times contribution margin per unit. So if that's the case, then you go ahead and you just start to set this up, don't you? If it's me, I'm starting with the contribution margin per unit. Okay, let's go ahead and let's look at this one. I've got less than half the class voting for some reason. That's shouldn't really take us this long.
Do this.
This not this long of a problem. Okay, but maybe we're getting tired. So let's do this. When C is the correct answer, most of us who voted got it right. Okay, but let's just take a look here. And again, break-even point in units. This is what we're trying to figure out. Obviously, we must have the means then to figure out these two. And I'm going for contribution margin per unit first. Contribution margin is sales price minus variable cost gives me contribution margin. Okay, so what am I going to do? My sales price is what? 20. And then I just start subtracting my variable cost. Now here we go. Prime cost. Okay, sorry guys. Got to know that prime cost is direct labor and direct material. Are direct labor and direct material variable? Yes, they are. So I now have to subtract that. Manufacturing overhead variable. Thank you. Selling and administrative variable. Thank you. Just taking the variable cost. And that gives me then contribution margin of what, 12? Per unit. Okay, so I've got this $12 per unit. $12 per unit. Okay, but now I got to figure out my fixed cost. Well, look, they're telling me that what? That my sales were 900,000. And if my sales are 900,000 and I'm selling the things for $20 per unit, that means I sold what, 45,000 units?
Yes.
Yep.
Notice it's gonna mess with me to the very end, isn't it? 45,000 units. Somewhere up there, someone's laughing their sick ass off at me. Okay, so 45,000. Okay, and so 45,000 units times my what? Times my fixed cost, which is 7 and 3. 7 plus 3, right?
10.
Which is 10. Thank you. So 45,000 times 10 means that my total fixed cost must be what? 450,000,
Yep.
which I can put over here now. 450,000 divided by what?
$12 a unit.
$12 per unit. Good. Gives me the break even in units here. The answer to this question was 37,500. Okay, now, guys, I know that the book gave you just take the fixed cost divided by the contribution margin per unit, but you can see how a question like this puts you in kind of a difficulty. What was the formula again? Whereas if you just remember the relationship, then it becomes a lot easier, in my opinion, you know, to understand this sort of algebraic manipulation that we're supposed to do to kind of fill out and find what you're looking for, because they could have sat here and gave me the break even in units and asked me to figure out the fixed cost. And I could have done that by remembering the relationship here. They're not always going to, you know, sit here and you know, they maybe wouldn't have given me the tools to calculate the fixed cost, but I could have calculated it by knowing the break even in units. They would have told me break even is 37.5, contribution margin per unit. Maybe they make me calculate that. Maybe they tell me it's 12. I can figure out the fixed cost, right? That way as well. So, okay. Question? Okay, guys, good work. I know I'm pushing you a little bit hard. You need to be keeping up with this stuff because you can see that we kind of build a little bit as we move from chapter to chapter here in the BEC section. I am not going to go through module 3 next time. I want you to look at that on your own. Module 3 is more ratios. There's repeat of ratios we've already talked about. I think they dump every ratio here. So again, your job is to go through, make sure you've got a good flashcard for all the ratios, have those ratio flashcards available for you, practice with the problems. Okay, you don't need me to sit here and tell you, you know, that you take sales divided by, you know, profit to get profitability or something. Okay. All right. So
Just yep.
Right. So we will pick up module 4 next time. Okay. And we should be in good shape to finish chapter 4. What chapter are we on? Chapter 4. Okay. Very important. You got to show up and you got to be ready for action for that variance analysis. That will absolutely make the difference for you in passing the exam, is knowing how I'm going to have you approach variance analysis questions. Okay. Okay, good. Any other questions before we go? All right, guys, have a good, productive weekend. I will see you on Monday. Okay.
All right.
Thank you.
Bye.
Thank you. Thank you, Professor.
Thank you. Good night.
Good night.
Thanks, Professor.